Ladies and gentlemen, boys and girls, asset allocators and degenerates of all shapes and sizes, welcome back. After Juneteenth, we are back. We are so back.
Guess who's back? Back again. Shady's back.
But this is no time for games. The S&P 500 just put out a red day, led by some very ugly price action by Nvidia. And the last time we saw peak to trough drawdowns in Nvidia of more than 6%, the S&P 500 tumbled 5% in the 3 weeks following in April. So with OpEx around the corner and trillions of dollars worth of gamma rolling off the tape tomorrow, we need to talk about what happens when dealers stop buying dips and the market is free to move in whichever direction it chooses. Will there be a pullback and will we collapse? That's what we're going to discuss here today. We'll also be asking and answering the question, why is sentiment so bullish and can it continue? And we'll be tackling this from the macro point of view as well as the fundamental point of view. We're also going to be talking about the consumer as well as some key technical charts from BofA's trade desk. We'll be able to get an insight into what big money is looking at, and this is an edge we can extract from the market. So what exactly do BofA see that we don't? Are they bearish or are they bullish? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video and leave a comment for the algorithm. Let's get into it. Now this is the daily heat map of the S&P 500. We have a lot of stuff to talk about, some very glaring things, a lot of divergences in the market here today. It's got me a little bit worried, but we're going to discuss everything now. The very first thing we see is something that's absolutely glaring. Firstly, semiconductors. Everything apart from AMD absolutely tanked in terms of semiconductors. And we also look here, semiconductor equipment manufacturers and Cadence Design Systems, which should be in this area right here. So semiconductors across the board except AMD were just red. So yeah, definitely an intra-sector rotation here into AMD. We also saw stuff like Apple fall 2.5% and then most of infrastructure tech, including Microsoft. And that's just the thing. When you have the three big names, the three big movers, Apple, Nvidia, Microsoft, all red on the day, you're going to see a down S&P 500. And that's exactly what we saw today. However, in the context of everything else, software, very green here in software stocks. Same with financials, actually green across the board. We did see some of the mega cap names put out good returns. Look at Google up 0.71% as well as Meta, Amazon too. Tesla took it on the chin despite all of the XAI, Dell, SMCI news. I guess you could say that, you know, the Tesla news with regards to semis was more of a buy the rumor, sell the news type of situation. We saw stuff like Chipotle down 6.22%. We also saw Hims & Her Health down 9%. So, you know, these hyper growth names and growth sectors really took it on the chin today, and the market really traded in favor of pretty much everything else, especially commodities. We saw commodity sectors were the best performing sector today, and that's because commodities went on a bit of a rally here today. We saw GDX up 2.52%, XLE up 1.84%, XME metals up 1.38%, and utilities highly leveraged to energy up 0.87%. Then the worst performing sectors were the XLK, SMH, so technology, semiconductors, so pretty much Nvidia, Apple, and Microsoft. And then we also saw staples here down 0.22%, a bit of a weird outlier in my opinion. And then we actually had XLRE down 0.26% and ITB, so real estate and home builders, home construction down 0.53% there as well. All in all, the S&P 500 returned 0.27%. And that just goes to show the weight of technology and semiconductors here in the SPY when you have the majority, the overwhelming majority of sectors in the positive, very positive, especially some of these big sectors, XLC, XLF, contrast with these big tech names, these mega cap names underperforming to actually get a negative S&P 500. It just goes to show the magnitude of these names. Now, let's actually quickly talk about real estate right here as well as home construction. They were down significantly on the day when the broader market was actually up, and it had to do with some of the data we got here pre-market. You could see housing starts actually came in negative 5.5% on a month-over-month basis. Brutal, absolutely brutal. Housing permits 1.386 million. We were expecting 1.45, another terrible stat. And then housing starts for the month of May 1.277 million. The consensus was 1.37 million. So this had an obvious tangible effect on real estate stocks as a whole. But in the face of this very weak economic data, yields actually rose. The 10-year yield was up 1.14% today. You think that on the back of weaker data, yields would actually fall, but we didn't actually get that. And I think the reason why yields didn't fall, yields were a bit up, was simply because investors were selling bonds and actually rotating into stuff like commodities. TLT was actually down 0.67% today, and gold was up 1.34%. Silver was up 3.37%, and my silver position is up 6% since taking it on Monday. Crude was up 0.72%. So I think we got a little bit of a rotation here. People were just selling bonds, the AGG, the TLT. And when you sell bonds, yields rise as a result, and investors and traders were rotating from bonds into commodities and commodity driven sectors. And that was also in the context of the mega caps being sold in favor of the broader market. Now, the S&P 500 was down 0.25% today. The Nasdaq was down 0.79%, but the RSP, the equal weight, was actually flat, 0.006% return, a little bit softer in the after hours. However, in comparison to what the S&P 500 and the Nasdaq did, complete outperformance on the equal weight side. Small caps weren't so lucky, they did 4.4%, and then mid caps were a little bit soft as well. With all of that in mind, there wasn't a lot of congruency today. We had weird action in yields, commodities, the broad market, but the S&P 500 actually did put out another all-time high today, not a closing high, but we did actually get to the 5,500. That's a key level we've been talking about for the last couple of weeks, especially when the core resistance moved up to the 5,500 area. We wicked right below it and we've come down, and you can see that this 5,500 is a very, very strong line of support. So for those of you that were buying dips, selling rips here to the 5,400 strike when we said to do so, and then we moved our target up to the 5,500 strike, I would probably look at taking a bit of profit if you are in at this stage right here. However, very, very strong price momentum, and I do think that this is actually going to continue in the context of the mega caps, stuff like the Nasdaq trading sideways and stuff like the RSP actually outperforming, moving to the upside, and we're going to see a bit of a broadening out here in the market. We are starting to see that. We are starting to see breadth improve ever so slightly. However, the market as a whole on a short-term basis is still relatively overbought. You can see here the RSI still above the 70 range on the S&P 500. The same is true for the Nasdaq 100. But looking at stuff like the IWM, there's a lot of gas left in the tank. Same here with the RSP as well as mid caps. But the S&P 500 had a very, very interesting day of trade. I mean, up until the last couple of hours of trade, it was looking very, very grim. It was actually looking like we were going to put in a bearish engulfing candle, and we actually did technically today, but you do have to understand in the context of this wick right there, a lot of buyers came in at the lows. Let's actually just look at the 5-minute chart, right? We gapped up on the weaker data news, but yields didn't do what they were supposed to do on the back of the weaker data, and the market actually started trading lower, and that was compounded by the fact that stuff like Apple, Microsoft, Nvidia, semis as a whole just weren't participating. But buyers did find support here at the 45.50 level. Buyers found value and actually bought the dip right here. So it did make for a bearish engulfing candle, however, not super bearish because of this wick right there. However, still a bearish engulfing candle at the 5,500 level, a level we've been talking about for a while. And again, I would say that, you know, if you can get out here at the 5,500 level, take some profit on your positions, but still hold. We are going to go higher in the interim, but where we go and how fast we go is going to be dependent on what happens on OpEx tomorrow. So a couple of things. The gamma flips at 5,500. Once we have all of this gamma roll off the tape, we want to see where the strikes reposition, where the put support repositions, where the gamma flip repositions, and where the call resistance repositions. Once we get that data next week, Monday, or over the weekend, we can formulate a game plan for the next month ahead. So until then, we're in limbo right now, guys, but you should have already made a lot of money here in the month of May as well as June, because here at the 5,200 level and here at the 5,000 level, we said buy the dip, don't trip, wait for the 5,400. We got to 5,400. We said wait for the 5,500. We got to the 5,500, and now we just got to buy out time. So take some profits for those of you that are long, but you do zoom out. We look at stuff like the weekly chart. It probably does look like we are going to put in another new weekly closing high. If we just close flat tomorrow, we are in an uptrend, and you don't want to fight the trend here on the weekly. Looking at the monthly chart as well, you can see very, very bullish for the month. We're actually at the highs here on the monthly chart, but the month's not closed, so we can't really take it into account. And then also just looking bullish on the daily chart. So we're looking bullish on the monthly, we're looking bullish on the daily, we're looking bullish on the weekly. You don't want to fight the trend unless we actually start to see a real breakdown in the daily, which then moves into the weekly. That's when we can start looking for weakness in the market. And the fact that we actually saw the RSP outperform the S&P 500 and the mega caps, it does go to show that maybe the rotation trade is starting, and that towards the end of June we'll rotate from the mega caps into the broader market, and that should allow us to continue higher for the rest of 2024. So guys, we're in limbo right now. No trade plan for the next week. We're going to wait for the weekend. We're going to wait for the new gamma data, and then we're going to go from there. Now, according to the AA sentiment survey, 44.4% of people are bullish. We saw a very slight decrease, although inconsequential. And those that are bearish, 22.5%, a slight decrease as well. So what we saw is a lot of people go here into the neutral camp from either sides of the spectrum. But we are still very bearish. Now, many people think we're going to pull back because of this, but contrary to conventional wisdom, historical data suggests that high bullish sentiment, particularly in the AA sentiment survey, precedes further market gains. You know, momentum brings momentum, and this suggests that the current optimism may be a sign of a continued uptrend, indicating that any dips we do get here, you want to be buyers of those dips because there's not many bears, there's a ton of bulls, and momentum brings momentum. I've been saying it all year, I'll continue to say it, because as sentiment remains bullish, the market is poised for further upside. Let's talk about earnings. We've got the latest data here from Goldman, and it's bottom up S&P 500 estimates year-over-year growth, and you can see this is Q1. Now, these are actual analyst estimates, not actual reported earnings. We do know that in Q1, we actually reported 8% S&P 500 earnings growth so far. Earnings season is not quite done, but that's probably the figure we're going to land on. So we've seen earnings come in very good. Now, the second quarter here, the expectation is 9%. The third quarter as well, 9%. So we are looking at very robust earnings growth for the rest of 2024. And then the fourth quarter, double-digit growth, 14%, mid-teens growth, very robust growth. This is part of the reason why S&P 500 has actually been so resilient, as well as earnings revisions. You can see that the typical path of the S&P 500 normally sees estimates fall by about 8%. So in other words, if earnings are expected to be 10% reported, we normally see an 8% median revision, which means 9.2% is what analysts are expecting at the start of earnings season. This is us right here in 2024. We're pretty much tracking near the zero line, and this is one of the major reasons why stocks have been so resilient. You've seen outperformance in revisions as well as what companies have reported against the typical median, and this is what we've done in 2023. And in an environment where revisions are barely getting revised to the downside and earnings are coming in better than expected, equities tend to rally. Now, what are companies doing with that money? Well, they're buying back stocks. Buybacks are accelerating, the highest since April 2020 according to BofA, and they say trailing 52-week BofA corporate client buybacks as a percentage of S&P 500 market cap, it's actually accelerating, and we're seeing buybacks move to the upside. Companies are using the earnings that they're making to buy back shares, giving money back to shareholders. Now, this is a very interesting chart with regards to buybacks as well as M&A, mergers and acquisitions. The spending on share buybacks and M&A is currently near 2019 levels, so pre-COVID, while the increase in net debt is much lower. So you can see here, 2016, 2018, 2020, net debt, long-term changes in net debt actually increased significantly. So too did share buybacks and acquisitions. We can see that with buybacks and acquisitions increasing significantly, but not so much here in net debt. That just goes to show that companies are making more money and they don't have to take on plenty of more debt to do that. In other words, balance sheets are becoming far healthier, and because of rate hikes, S&P 500 companies have become far more resilient, and we've actually seen balance sheets become far more healthier. Now let's talk a bit about the macro. This is the Fed's GDP Now estimate for Q2 2024. It's essentially what the Fed believe GDP is currently tracking for the second quarter here in 2024. And right now we're sitting at about the 3.1% level, just slightly above 3%, 3.1% maybe. And this tends to be a very accurate predictor of what GDP is going to do. Now, the blue chip consensus, pretty much investment banks and research firms, think that GDP is probably going to come in closer between the 2 to 3% range, as you can see right here. The blue chip consensus is actually at 2%. The Fed's GDP Now is tracking a little bit above that, and I guess the truth will be somewhere in the middle. Now, this right here is the consumer confidence meter here by BofA. It looks very childish, but it's a very good meter, and let's dive into it. So they say our tracking, the US economy meter actually declined in May. So they look at spending, DPI, earning and employment, confidence and borrowing, housing and mortgages, and then the cost of living. And they essentially rate this as improving for the consumer, declining for the consumer, same as the previous month. And you can actually see that every indicator here in May stayed the exact same except for confidence in borrowing, and that's why this actually moved down. Now, why did that change? Well, we were actually expecting expecting rate cuts in March 2024. We were expecting the first rate cut in May. It's now moved to September, and that's why confidence and borrowing has actually moved down. So this is consumer confidence, and borrowing for the 5th month in a row is actually declined here. That actually was offset by earnings and employment, but that wasn't the case here in May. So the consumer confidence meter did actually decline. Now, on the topic of the labor market, this is a very interesting chart by Goldman. They say a further softening in labor demand would likely hit actual jobs, not just open positions. The labor market is now fully rebalanced, with the job workers gap, the difference between job openings and unemployed workers, back to its February 2020 level. So essentially, after COVID, the labor market was out of whack, out of balance. We're now into this equilibrium zone. You can see we've declined. This right here, this red line, is actually the 2009 to 2020 period. This is where we should be, and we're slowly approaching that. Still a bit elevated, but we should come back into this equilibrium trend over the next couple of months. And this is why the Fed right now are so attentive to movements in the labor market and are willing to cut the second they see any type of weakness in the labor market. But at the same time, real wage growth will stay elevated. 2024 nominal wage growth will equal 3.75%. Real wage growth would exceed 1%, just above 1%, and this is expected to continue. So consumers are actually gaining a bit of pricing power here with regards to real wage growth. So this is wage growth adjusted for inflation. This is very, very healthy. You can see this is probably at around the average since the year 2000. And this is really where you want consumers to gain pricing power against the rate of inflation. This is really good for earnings, really good for the economy. And as long as the unemployment rate stays in check, it doesn't go higher than, let's say, 4.1%, the economy and consumer spending will continue to remain robust. Now let's talk about seasonality, a very interesting chart here. This is the S&P 500 seasonality, the first 10 sessions and last 10 sessions of each and every single month in a presidential year. And they say early June is the strongest 10 session period for the year for the S&P 500 in presidential election years, with average and median returns of 1.59 and 1.47% respectively. After that, the SPX tends to continue a summer rally into August ahead of a pre-election dip in September to early October, and then a recovery into year end. So this is where we are right now in June. We tend to have a very positive June. We have seen that in the first 10 days. And the next 10 days tend to be quite lackluster, but then we actually have a rally all throughout July, all throughout August. Average returns 0.93, 0.82, 1.53%, 0.81%. Then we have a lackluster September and October, and then we see life come back into the S&P 500 on the back end of October into December for what we normally call the end of year Santa rally. So what should we be doing at the moment? We should be holding our positions, holding equities, because more gains are likely to come, and then we should be buying the dip, adding around the September, October area for what could be a stellar end of year run. Now looking at gamma, look, not much has changed into OpEx. 5,500 is still the zone, so you want to be buyers of dips, sellers of rips to that 5,500 area. Very interesting to see the put support literally went from the 5,300 area right here all the way back down to the 5,100 area. That just means volatility is expanding, and we've actually seen the gamma flip zone move up to the 5,395. Let's call it the 5,400 zone. So the 5,400 is now going to act as strong support on the way down. But if we do actually break below this, there's not much negative gamma support up until the 5,100 area. So if 5,400 doesn't hold, guys, we could definitely see downside momentum. But up until OpEx, up until Friday, you want to be buyers of dips, sellers of rips. Look to the 5,500 area, and then once all of this gamma rolls off, and then when we see where it repositions, then we can start working towards July OpEx after the window of weakness. But for now, buy dips, sell rips. This is a positive gamma heavy environment, and you don't want to fight the trend. And right now, that trend is up. This right here, this light blue line, is 2024 year-to-date performance of the S&P 500, and this dark line right here is what happened in 1995. And the S&P 500, while not tracking exactly what happened in 95 was to the bottom and to the top right. Kind of ridiculous. We have seen quite a bit of volatility that is healthier, but we are tracking the 1995 period very, very closely. I wouldn't be surprised if we do continue upward. I just showed you the presidential election year seasonal chart. More upside is likely due. We actually do get a bit of a pullback here in this August-September period, and then in late October, we normally do go higher. But in 1995, the dip was very short-lived. So guys, any dips we do get like this, you want to be big buyers, because sometimes we can go months, January, February, March, April without a dip at all, and we could just, step higher, and then before you know it, we're 10% plus in the index from this level right here. So don't fight the trend is up. All right, guys, let's dive into some charts. These are charts here from BofA. They often send these out to their private clients. The reason why we look at this is because 78% of fund managers have access to BofA's data, and so they're probably looking at these, and it's a bit of an edge for us to also have a look at these when we can. Now, S&P 500 weekly chart with 40-week and 200 weekly moving average, new all-time highs with cup and handle targeting 5600 in sight. So you can see we got a cup and handle right here, then we got a break above this level with the potential upside target of 5600. You can see a measured move from this point to this point right here takes us to 5600, and then if we actually look at a breakout from the all-time highs, we can actually get to 6150. Very, very bullish levels to the upside right here, with support again here at the 5340 and the 4819 to 4793 if the market does pull back. All in all, very, very bullish. This looks bullish, and 5600 by the end of the year, not out of the equation. Looking at a very similar chart here when it comes to the Nasdaq, same thing, cup and handle, a breakout right here, so breakout above the all-time high, and then break up above the top of the cup. Takes us to a measured move level of 21,200, 2,300, tons of support on the way down. We have support here at 19,500, support at 18,400, and then 16 to 17,000 region if we do pull back. That being said, again, very, very bullish, and we can actually see 21,200 by the end of the year. Looking at the iShares Russell 2000, we still are forming this massive, massive correction in time, trying to break above. The key level to break above is the 208 to 212 zone. If we can break above this, use as support, we can then actually rally to the 234 level, 244.46 level, and then the 260 target in the IWM. Looking at small caps versus large caps, small caps tend to lag larger caps during secular bull markets and tend to outperform large caps during secular bear markets in the S&P 500. So this is the S&P 500 index, as you can see, S&P 500 large caps, S&P 500 small caps versus large caps ratio. So you can see here that when we are in a bull market, small caps tend to underperform. When we are in a correction zone, small caps tend to outperform. And as we are in a secular bull market here in the S&P 500, small caps actually are outperforming. What we're seeing is just completely normal historical price action. However, I do think small caps are pretty cheap, and I do think that if you have a very long-term time horizon, the risk to reward for getting into small caps right now is very, very attractive. If you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.